Ladies and gentlemen, welcome back to the channel. Jackson Hole is over with, at least the part that we care about, and that was the speech from Fed Jerome Powell. Here in this video, I will go over all of the most important aspects of this speech, what was left out of this speech, and how markets are likely to react to this speech over the next coming days and weeks. We'll tell you right now, there's a lot of volatility in markets, but it is being seen as a risk on event, with the Russell up over 3% and almost 4x outpacing the S&P 500, which is only up at the time of recording this video about 0.73%. Heading into this Jackson Hole event, the S&P 500 is on pace for the second strongest year-to-date performance since 2000. So the fact that we are continuing to rally after this speech is pretty impressive in and of itself. Nick Timmerhouse writes on X, the Powell pivot is complete. Powell is dovish across the board from the same stage where he 2 years ago signaled the Fed would accept a recession as the price of restoring inflation. Here are some of your biggest quotes from Powell today. Quote, the cooling in labor market conditions is unmistakable. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data and the evolving outlook and the balance of risks. We will do everything we can to support a strong labor market as we make further progress towards price stability. Do you know what this really was from Powell today? This was a speech about inflation being over with. Powell unfurls his narrative on the causes of and behaviors of inflation since 2020, recognizing not everyone will agree with his framing. He concludes with this. That is my assessment of events. Your mileage may vary. After recounting the series of judgments that led officials to describe inflation as likely to be transitory, Powell observes how widely shared these views were outside the Fed. He says, quote, the good ship transitory was a crowded one. Warren Pies on X says, translating Powell, the Fed put is back. And he also noticed what I noticed. Inflation was being discussed in the past tense, not as a issue that is continuing to evolve. No, there was none of that. Inflation was being discussed as a memory, right? As something that happened that we were reflecting back on, not something that is currently ongoing. So basically what you got today from Powell was the closest thing you will ever get coming out of Powell's mouth about an actual victory lap of inflation, right? Taking a victory lap, we did it, inflation is over with. Powell's never going to come out and say that. But today was the closest you are ever going to get to just that. And I think that's why ultimately small caps and the broader market is taking off today, because the fight against inflation is over with. Rate cuts are coming, and although we don't know when specifically rate cuts will start or how many cuts we will get, they are coming and they are going to continue to come. So Powell did say today the time has come to adjust policy, or soon has come to adjust policy, but he did not explicitly confirm September. I mean, who really thought he was going to? Like, I didn't, okay? A lot of people didn't, but generally speaking, the markets have priced that in with a 100% certainty. That's kind of where some of the uncertainty comes in now, is because, I mean, he did not confirm September outright. He did not confirm that the Fed's going to cut at, each Fed meeting going ahead. He didn't confirm those things. So that does create a little bit of uncertainty, in my opinion, and does still kind of rely on that data-dependent approach. If inflation comes in hot around September 11th and the economy continues to do well, is the Fed going to cut in September? Probably. But are they going to cut at every Fed meeting? Who knows? Some would say yes, some would say no. That's what's called uncertainty. And the markets don't like uncertainty. So if we do see some selling in the next days or weeks to come, it is because of that. FS Insight on X, which is Fundstrat's main X account, writes, real rates are 3x higher than at 2023 Jackson Hole. One of three reasons why we expect markets to ultimately view Fed Chair Powell's comments dovishly, equaling a risk on post-speech. But keep in mind, it is not uncommon for markets to sell off after Jackson Hole. In fact, it's actually uncommon for markets to do well after Jackson Hole. The Domino on X, Dominic Chu, he is a CNBC senior markets correspondent. They put this up as Powell was speaking. The average performance during the speech is negative 1.4%. I mean, that's not good. Okay, that's a really, really bad historical precedence. Only 2 times has this speech actually been positive: 1995 and 2007. The average 1 day later is negative 1.3%. So there's this, this speech is on Friday, so maybe there's time over the weekend to digest some of this information. You don't have to see anything really negative, considering we do have the weekend. But this does suggest Monday, it's going to be a bad Monday, okay? And the average is negative 0.8% until the next Fed meeting. Now, you are also heading into seasonally the worst month of the year over the past 10 years. September has been bad, just outright bad, okay? So mix this with that, and yeah, September is going to be quite interesting. You can see here, the S&P 500 has been down 4 years in a row for the month of September. Last time there was a 5-year September losing streak was 1999 through 2003. You could see here the 10-year average return in September is negative 2.6%. The only other month that is negative is December, and that's barely negative 0.2%. So September is by far the worst month in recent years for stocks. You can see 2023 was negative 5.1%, 2022 was negative 9.6%, 2021 was negative 5%, 2020 was negative 4.1%. Then you had a couple slight positive years there: 2016 negative 0.5%, 2015 negative 3.1%, and 2014 was negative 1.8%. So September just tends to be a pretty rough month in recent history. Bank of America says 5 of 6 Powell Jackson Hole speeches saw the S&P 500 drop 7.5% on average in the next 3 months. Who's left to buy? The S&P 500 corporate cash, just 8.8% of assets, often a bearish tip-off. So a lot of people on Wall Street are actually saying this could be the start of a larger selling spree for markets. Dan Ives writes on X, well, I guess shares on X, images of doves flying in reference to Fed Jerome Powell being dovish. Dan Niles writes on X, Powell's speech today is bullish for risk assets through year end. It is less hedged than expected and leaves the door open for rapid cuts in rates with no use of the word gradual. That's a very good point, Dan Niles. The important parts of the speech: my confidence has grown that inflation is on a sustainable path towards 2%. We do not seek or welcome further cooling in labor market conditions. The upside risks to inflation have diminished, and the downside risks to employment have increased. The time has come for policy to adjust. The direction of travel is clear. The fact that Powell used data dependency in the speech does imply that gradual is still possible, but if the economy weakens further, then they're just going to cut more. Zero Hedge on X writes, Powell summary: confirmed September rate cut. Does not indicate whether 25 basis points or 50 basis points. As such, the August payrolls report will be critical. At the same time as Powell's speech, we did get July new home sales, which were up 10.6% month over month versus the 1% estimate and 0.3% prior, revised up from negative 0.6%. Median sales price of new homes in July fell by 1.4% to $429,800. So this was the strongest, month over month homes data, right? 10.6% is crazy for new home sales. This was the strongest data we have seen since 2022, around August or so of 2022, if I'm looking at this chart correctly, when you had over 20% growth. So 10.6% month over month is huge, but yes, we were coming off of a low last month and a very low month before. So is it that impressive? In my opinion, not really, but I do want to point this out. With the economy seemingly slowing and the labor market slowing, there is the vast majority of Americans' wealth in their homes, okay? If they are able to actually sell their home now and let's say pay off the mortgage and, bank a couple $100,000 into the bank, they're going to spend a lot more. That's a stimulative measure in the economy, okay? And I think that is one area of potential upside activity that not a lot of Wall Street is talking about right now. I like to see the good and bad. I'd like to try to forecast the good and bad. Like, what are the odds of an upside surprise to growth? And where do they come from, right? What would be the source of an upside to growth? And I really haven't had anything to put in that category for a while now. Like, we're not going to get stimulus checks. It's highly unlikely the economy just by itself is going to accelerate from here. Okay. But an upside area of growth or spending could come if people can start to sell their homes. That's going to give people a lot of money. And you can see here, 2-year Treasury yields plunged to 3.95% as Fed Powell says the time has come to cut interest rates. It says the Fed doesn't seek or welcome further cooling in the labor market. That does mean the 2- and 10-year yield curve is uninverting quite a bit in the last couple of days, from 20 basis points inverted now only to 12 basis points inverted, which historically when the yield curve uninverts, that's usually a risk off sign. That's usually when you want to be heavy in cash, you want to be in some puts, potentially looking at some put positioning. But it doesn't have to coincide that way. Bespoke on X writes, Powell at Jackson Hole 2022, quote, restoring price stability will take some time. 2024, the time has come for policy to adjust. So some time equals 2 years. Ryan Dietrich writes on X, the past 6 months, small caps are up 9%. The past 12 months, small caps are up 18%. The past 5 years, small caps are up 50%. Yes, they aren't up as much as large cap tech, but we continue to expect them to do quite well the rest of 2024 and likely lead their large cap brothers. And one of the next big catalysts for our markets will be Nvidia earnings coming out next Wednesday. With that said, Tesla stock is up almost 4% today. It has been a volatile day for Tesla. At one point, you were almost $222 per share. Now you're $218.50 or so per share at the time of recording this video. I do think the path ahead for markets as a whole is going to be volatile. Nvidia earnings are going to be important. Economic data is going to be important. Still, I do think if the economy weakens from here, that's not going to be good for markets, generally speaking, even if the Fed is there to backstop things and cut rates when they need to. I don't think weakening in the economy will be good if that happens. Best case scenario is the economy just does okay, and that allows the Fed to cut rates, or the economy is on the stronger side. And that will really give a good backdrop to equities. But historically, September is the worst month in the last 10 years, by far, for markets. We're heading into September. And Jackson Hole doesn't tend to be a positive catalyst either. So it's possible we could trend lower. It's possible we could get a little bit of selling from this event, but it's also possible this time could be different in the sense of we're declaring victory on inflation for the first time since the 70s and the 80s. Okay. This is really uncharted territory for anyone on Wall Street. Okay. Declaring victory on inflation is typically a great thing as long as we're not heading into a recession. So as long as we're not heading into a recession, it is very well possible the Russell, anything tied to interest rates, anything that is cyclical in nature, could do very well, very, very well from here over the next couple of months. I do think a pretty easy conclusion is you're going to see small caps do way better than large caps. Okay, even look at today. Apple up 0.7%. Okay day, fine. Meta up 0.03%, almost red today. Google is up 0.86%. Microsoft up 0.08%, almost red today. Amazon up 0.8%. These companies are not doing that great relative to the Russell that is up 3.4% today. Even if you look at the RSP, the equal weight S&P is up 1.35%, outpacing all of your big tech stocks besides Nvidia that is up 4%. And Nvidia and Tesla are like the two big tech stocks that are just different than Apple, Meta, Amazon, Microsoft, Google, right? They're higher growth in nature. They're more tied to the economy. Semiconductors, I know people are going to say Nvidia is not tied to the economy. Semiconductors are always cyclical in nature. Okay, if the economy worsens, there's a recession, budgets are going to get cut for semiconductors. Semiconductors are cyclical, very cyclical, and tied to interest rates heavily. Okay, how do you think a lot of these companies pay for their GPUs? Some of them pay for them in cash, clearly, but a lot of companies are going to go out and they're going to leverage to buy these, hundreds of millions of dollars worth of GPUs. So I do think Tesla and Nvidia are exceptions to big tech, and I do think those two names can do much better than big tech as we do head into this Fed cutting cycle. As I've talked about many times before here on this channel, big tech, Google, Apple, Meta, Amazon, Microsoft, the cohort there, they have actually benefited from rates staying high because those are the companies you'd want to be in if we go into recession, which normally happens when the Fed raises rates as aggressively as they did. Their cash in the bank, technically in treasuries, pays them good yields, and that just adds to their bottom line profitability, right? These are two strong reasons why big tech has done so well, which has, yes, kept the S&P at elevated levels. But as that starts to flip, as the Fed starts to lower rates, it doesn't affect big tech the way that it does small caps or Tesla or even Nvidia for that matter. There's really no benefit to these large cap names in that environment. So I do think Tesla is going to act more like a small cap stock. And Tesla really always acts more like a small cap stock, if we want to be honest. Tesla, let's just think about it like this. Tesla's still down from all-time highs, which when we hit all-time highs was a pretty euphoric period anyway, so take that into consideration. But Tesla is still down massively from its all-time highs. You still need a 90% gain from here to get to all-time highs, okay? You're still down 47% from all-time highs. If you take a look at the IWM, I mean, you're still down quite a bit as well from all-time highs. Still down, well, only about 7% now, which it was a lot worse. It was like 20% or so. But you could see Tesla has always really traded more like a small cap stock. than the S&P or a large cap stock. Here on the day today in Tesla stock via interesting flow sentiment on Ortex, you can see 5 different trades totaling $1.57 million with a positive order value of 69%. Short sellers are covering in droves yet again in Tesla stock. You can see over 2 million shares are being covered today, only 170,000 shares being sold short today. That means on net, you have about 1.9 million shares that are being covered today. So yeah, Wall Street does not want to be short in Tesla. And even yesterday you had like 3 million shares on net that were actually covered on. So short interest of free float today sitting at 3.12%, $18.28 billion currently sold short. You do have the amount of shares currently sold short at 86.77 million. The CNN Fear and Greed Index is sitting at 52, which is still just barely over neutral. There is a lot of rally that could still come in our markets before you're in greed or extreme greed or too overbought, if you will. The percent of stocks currently trading above their 50-day moving average is, soaring today. Almost 9% of stocks are breaking above their 50-day moving average to 66.08% of all stocks trading above their 50-day moving average. That's still not a super impressive number, right? That's just a healthy, good number. Back even July, right? July 17th, July 31st, you were in the 70s. July 17th, you were 75%. So you could still go up a lot more. You could still see the breadth of our markets, the internals, the average stocks rally a lot more from here before you're getting to a place of being too overextended. And honestly, just in my opinion, it wouldn't surprise me if we continued to see this outperformance of the Russell compared to the S&P 500. And it's interesting, over on StockTwits, sentiment today is bearish at 43, the same as yesterday. Message volume is at 51 today. Yesterday it was at 49, so a little bit higher than yesterday, but nothing super spectacular. And the participation ratio today is high at 55. So that is going to do it for this video. I did want to mainly just talk about Jackson Hole today in this one. In the next video, we will specifically go over what this could mean for Tesla over the next couple of weeks, if this makes Tesla more attractive, if the odds of a larger rally just increased, where I think Tesla could go heading into the October 10th event, and all of that kind of information in the next video coming out at 8 p.m. tonight. And trust me, you do not want to miss it. It's going to be pretty exciting. So let me know what you think about all of this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.